Family offices and ultra high net worths are putting double digits of their overall portfolio into this little known and very secretive asset class. In today's video, I'm going to break down exactly what this asset class is, venture capital funds, how they work, and when it makes sense for someone to invest in a venture capital fund as well. Hey guys, my name is Ibrahim Khan. I'm the founding partner at Curate Capital. We're a venture fund based in the UK. We've invested over £10 million in over 50 different companies over the last few years. And we've been very lucky to have co-invested with some of the best names in the business, people like the co-founders of Airbnb and Twitter and Red Bull and various others like that. Before I was at Curate Capital, I used to be a corporate lawyer working in venture capital funds formation. So in today's video, I'm going to be sharing all of that inside view and experience on how venture capital funds actually work with you as well. In order to understand what a venture capital fund actually is, let's first understand what it invests in. So a venture capital fund invests in early stage companies, the type of companies that could go bust or the type of companies that could go to the moon and back. And the venture fund will focus in on these kind of companies and set up the entire infrastructure, fund economics, management, everything, investment strategy in order to achieve the one goal of getting into the best such companies in the world. And we'll go into exactly how they do that in just a second. But first, what kind of flavors do venture funds come in? You see, you have venture funds that decide that, look, we are going to focus on a specific geography, such as the USA or Latin America or Europe, and that's what we're going to do. The second way that certain funds will differentiate themselves is by saying we are only going to invest in fintech startups, or we're only going to invest in startups that are related to software as a subscription business model. And that's the way they specialize and narrow their focus. And then you have certain funds that focus not on types of investment, but on the stage of the company. So you have early stage funds that invest at pre-seed, seed, or Series A. That means very, very early on. Or you have funds that come in at a later date. This is at the Series A, B, or C stage, at a point when the company will have dozens and dozens, if not hundreds, of employees and is turning over usually in the millions of pounds in revenue. The reason why funds focus in on specific sectors and specific geographies is because they want to give themselves an edge. You see, in venture, it's all about getting into the top deals. And if you are a specialist in a particular area, that makes it much easier for you to walk up to a startup from that specialist area and say, look, we know what we're talking about. Here's 15 or 20 companies that we previously invested in and benefited, and we can give that to you as well. That's a much easier sell than saying we're a generalist and we like the look of you, can you let us invest please? Now, on the other hand, when you have venture funds that invest at different stages, this is not about specialization, although there is a little bit of that. Really, these are different ball games, because you see, when you're investing at the early stage, it's a completely different discipline to when you're investing at the later stage. Because at this early stage, you only have a couple of founders and perhaps just an idea on the back of a napkin. And then at the later stage, you've got full financials and historic records and everything that you might want to have under the sun. It's a very, very different kind of ball game. So make sure you keep that in mind. Okay folks, let's get into the numbers, because that's going to explain to you a lot on how the money actually flows. In the market, the standard is that you will pay a 2% management fee to the fund manager every single year for the life of the fund, usually around 10 years. And also, any profit that is made, you will give the venture fund manager a 20% carried interest, or a 20% profit share. So let's say you have a $100 million fund, and that becomes a $400 million fund by the end of the 10-year cycle. That $300 million in profit, 20% of that would go to the venture fund manager, i.e. they would walk away with 60 million of the profit and you would get 240 million of the profit. And the original 100 million, of course, you would get that back as well. And so that's how venture funds make money and distribute money. And in order for a venture fund to get to that magical $400 million mark, they will want to invest in companies that are going to make it really, really big. For complicated reasons, and I'll put some links to resources in the description below, venture funds want to have 20 or 30 or 40 companies in their portfolio and really hope that at least one or two of them have a 20, 30 or 40x return. They want to invest in companies that have that potential to completely change the size and scale and success of their portfolio. They're not interested in investing in companies that are going to make them a nice 2, 3 or 4x return. They need companies to be making a 20 or 30 or 40x return, because they know that a few of these companies are going to completely fail as well, and that's going to need to be dragged up by the average. In other words, venture funds are all about trying to hit the ball out of the park every single time. It's a high stakes, high risk, high reward business. Okay, Ibrahim, venture funds sound pretty cool to me. What kind of funds are out there and how can I invest in them? Okay, so there's three main types of venture funds out there. You've got the institutional funds, the ones that are raising tens of millions, if not in the hundreds of millions, that are out there as well. Minimum tickets for those kind of funds are usually going to be $500,000 or even a few £1,000,000. And for most people, that makes it a little bit challenging to get into. And actually, sometimes it doesn't even matter about the money. It's more about knowing the person that runs such a successful fund to get yourself access to that sort of thing. The second type of funds, other than the institutional funds, are rolling funds. So AngelList and other platforms out there allow you to invest in some smaller micro VC funds that will allow you to actually invest regularly every quarter as a subscription type model into a VC fund. And then finally, you have the UK equivalent of that called an EIS fund. An EIS fund is a structure that is set up that is specifically designed to allow UK investors to benefit from a highly lucrative UK tax scheme called EIS. It doesn't mean, by the way, that overseas investors can't invest in an EIS fund. It just means that UK investors get additional benefits. So there you have it. You've got institutional funds, you've got rolling funds, the type that are offered by AngelList, and then you've got UK specific EIS funds that everyone can invest in as well. Okay, so you decided what kind of VC fund would be the most appropriate for me given the kind of tickets that I have. Do I have millions of pounds or hundreds and hundreds of thousands of pounds, in which case an institutional VC fund might be right? Or do I have tens of thousands or hundreds of thousands of pounds, in which case a rolling fund or an EIS fund would be a more appropriate fit for me? So now you've decided what route you're going to go down. What kind of qualities of a VC fund should you look for in order to determine what is a good VC fund? In my view, there are three key things. The first is the team and their track record. The second is the access to deal flow and the ability to get into the best deals. And then the third thing is how the fund thinks about portfolio construction and making sure that it's giving your money the best chance at making a great return. With the team and the track record, really it is about looking at their offering document and getting comfortable that the team is in fact credible. When it comes to the deal flow and access to the deal flow, you want to ideally speak to the fund manager, or at least look through their documentation to understand why would an average startup take the money from the fund manager when they could get the money from elsewhere. If you get a compelling reason why that would be the case, then that is a great signal that this fund is actually going to potentially get into some of the best deals that it finds. Finally, make sure you understand the portfolio construction philosophy that this fund manager has. If they're going to over-concentrate into 5 or 10 companies, that may give you reason for pause. Or if they're going to invest in 50 to 100 companies, again, that may give you reason for pause, because it means that you're taking the risk of investing in venture, but without necessarily concentrating enough to get a really sizable outcome. My personal view, and this is not financial advice, is your typical successful VC fund usually concentrates between 20 and 40 companies as part of its portfolio. The big question remaining, guys, is are you going to invest in a VC fund, and is it right for you to invest in VC fund? Now, of course, I'm biased, and again, I reiterate, not financial advice, but you want to have a diversified portfolio, and particularly for those who are more affluent, who have significant savings, having an alternative asset section of your portfolio, i.e. a higher risk, higher reward or growth element of your portfolio, makes a lot of sense, because that portion of your portfolio gives you the potential of having a really successful outcome and significantly increasing your portfolio overall. But of course, one needs to make sure that you are constraining the amount that you put into alternative assets to such amount that you are comfortable with when it comes to the higher risk aspect of these kind of investments as well. Long story short, I think it's a pretty cool asset class, definitely one to consider and think through carefully. And if you do think about investing and are keen to invest, we definitely invite you to our website at curate.capital and check out some of the offerings that we have on there as well. I hope this video has been helpful. I'd love to hear your questions and thoughts in the comments below. Until next time, ciao.